Every stock you own outside the Magnificent Seven is alone in a crash. When the market drops, index money keeps flowing into the biggest names, usually the same handful of mega caps. The other names get no safety net. They fall and nobody catches them. Most people call that a reason to avoid them. I call it the reason to own the right ones. So here's a rule that lets me hold 5 of them through any crash. A falling price is not a broken thesis. That one line is the whole video. A stock can drop 40% while the business gets stronger every quarter. The chart is screaming. The fundamentals are humming. 2 different stories, and the market constantly mashes them into one. So, when one of my stock drops, I don't ask how far it's down. I ask one question: did the reason I bought it change? If the answer is no, the sell-off is just noise wearing a scary face. If the answer is yes, if the thesis actually broke, that's the only real sell signal there is. I've got 5 names I'd hold through the worst red day of the decade. Not one is the Magnificent Seven. One of them hasn't even launched its main rocket yet, and I'd still hold it. I'll get to why. I'm not a financial advisor. Numbers are as of filming. This is how I think about my own money, not a buy list. And stick around for the confession near the end. The real reason holding these is easier for me than it might be for you. It's the part most people completely get wrong. Each one lives in a different corner of the future. Cybersecurity, the optics of AI, the packaging of chips, AI cloud, and space. Different lanes, same spine. Everyone keeps compounding whether the ticker is green or red that week. And the no safety net part is the whole reason this matters. The Mag 7 has automatic money underneath it. Every paycheck, every 401k contribution, buying no matter what. Steady flow softens every fall. These 5 don't get a cent of it. So when they drop hard and fast, and the only thing standing between you and a panic sell is whether you understand the business well enough to ignore the price. No safety net means no shortcut. You either know what you own or you don't. The next drawdown is coming. They always do. And the day it hits, you won't be calmly reading a balance sheet. You'll be staring at a screen full of red with your thumb hovering over the sell button. The only thing that keeps that thumb still is knowing the business cold. So let me hand you the business. Start with CrowdStrike, cybersecurity. In 2024, a botched update from CrowdStrike took down airports, banks, and hospitals. Screens went blue around the world in a single morning. Flights grounded, surgeries delayed, and a lot of people called the thesis dead on the spot. Picture being inside that company. You wake up and your own software has frozen a global airline at the gate. Phones ringing off the hook. Every customer you have watching. That was the moment everyone assumed those customers would sprint for the exits. They didn't run, they bought more. Recurring revenue crossed $5.25 billion, up 24%, and it booked over $1 billion of net new business that year. A company record. Sit with that. The worst PR day in the company's history, and the customers answered by handing it more of their security, not less. That's not luck. That's what happens when ripping a product out of your business is harder and scarier than just staying. What I watch on CrowdStrike, whether net new recurring revenue keeps climbing. That one number tells me customers are still expanding, not quietly drafting their exit. As long as it grows, the thesis holds, no matter what the stock does in any given quarter. The next one is even less glamorous. It makes a part you've probably never heard of, and every AI system on Earth depends on it. Coherent, the optics layer of AI. Inside an AI data center, data has to move between thousands of chips, fast, without tripping over itself. That movement runs through optical transceivers, small components that turn data into pulses of light and back again. Coherent makes them. Everyone posts about the chip. Almost nobody talks about the part that lets one chip talk to the next. And the chip is useless without it. Revenue hit a record $1.8 billion, up 21%. And the data center side grew around 40% year over year, far faster than the rest of the business. Then came the tell. NVIDIA put $2 billion of its own money into Coherent. When the most important company in AI writes a check that size to one of its suppliers, it's telling you how critical that supplier is to the whole build-out. And the orders back it up. Coherent's AI transceivers are booked out through 2028. What I watch on Coherent, whether the next generation of faster transceivers ships on schedule. That's where the growth keeps compounding. A real delay there would be a crack worth taking seriously. Right now, there isn't one. Now, the quietest name on the whole list, the one nobody mentions, that nothing else here works without. Amkor Technology, advanced packaging. Everyone designs chips. Almost nobody talks about what happens next. Before a processor can go into a server, it has to be packaged, wired, stacked, and protected so it can actually do its job. Amkor does that for the most advanced AI chips on Earth. Record quarter, around $1.7 billion, up in the high 20s. And the slice doing AI packaging, management is guiding it to roughly triple off last year. It's a quiet link in a very long chain. But pull that one link and the whole chain stops. You can build the best chip ever made, and it's a paperweight until someone packages it. What I watch on Amkor, the new compute programs ramping, and whether the Arizona expansion stays on schedule. That's what brings advanced packaging onto US soil. It's a multi-year project, so I'm watching for steady progress, not one blowout quarter. Now the confession I promised you. Everything I just said is true. CrowdStrike, Coherent, Amkor, strong businesses, intact theses. But here's the part almost nobody says out loud. It is easy for me to hold these through a 40% drop. My cost basis is low. I bought a lot of this long time ago, back when nobody was talking about it. Several of these ran up into multi-baggers, doubled, tripled, more. On the way up, I trimmed. I took some profit. So for most of these names, I've already pulled my original money back out. What's left writing is, in plain terms, the market's money, not mine. Think about what that does to your nerves. When a stock you already cashed out of drops 40%, you shrug. You're playing with house money. When it's your rent money on the line at the top of the range, that same 40% drop feels like the floor falling out. Here's why that changes everything. When you buy low and a stock falls 40%, you're still sitting on a gain. When you buy at the top and it falls 40%, you're staring at a loss. And your brain treats those two situations completely differently, even when the business underneath is identical. So, the real lesson of this whole video isn't the 5 names. It's this. Your entry price decides whether you can hold. The name you own matters. The price you paid matters just as much. The exact same stock can be one hold forever or one you panic sell at the bottom. And the only thing that changed between those two people is what they paid to get in. So when I say I'd hold these forever, here are the asterisks. Forever lasts exactly as long as 2 things stay true. The thesis doesn't bring, and my conviction was built on research, not on the price going up. The day the thesis breaks, forever ends. That's the honest version. And anyone who tells you different is selling you something. 2 names left, and this is where the conviction gets tested hardest. Nebius Group, AI Cloud. This one is young, and the market treats it like a coin flip. Up huge one week, down hard the next. Look past the chart, and the story is a lot calmer. Its AI cloud revenue went from $41 million to $390 million in a single year, nearly 10 times bigger. And the customers aren't tourists. Nebius signed a long-term deal with Meta, worth up to roughly $27 billion over 5 years. You don't write a number like that for a science experiment. You write it for infrastructure you plan to lean on for years. Management is guiding to roughly $3 to $3.5 billion in revenue, with healthy margins as AI cloud scales. The volatility here isn't about whether the business works. It's about how young the business is. The market can't decide if it's staring at a startup or an infrastructure company. I think a $27 billion contract already answered that question. What I watch on Nebius, whether margins hold as they pour billions into GPUs. Profitable scaling is what separates real infrastructure from a good story. So far, it's scaling revenue faster than costs, though that can change fast as GPU spending ramps. Which brings me back to the one I teased at the very top. The name hasn't even flown its main rocket yet, and I'd still hold it through a crash. This is the one that demands the most conviction of all, so it goes last. Rocket Lab, space, like new space, not aerospace. Rocket Lab is building a big new rocket called Neutron. It hasn't launched yet, and every single headline about it, a delay, a test, a new date, sends the stock lurching like a weekly coin flip. That's the part everyone watches. Here's the part they miss. The business that already exists just posted a record $200 million quarter, up 64% with a backlog north of $2.2 billion. In 3 months, Rocket Lab booked more new launches than it did in all of last year. So, while everyone argues about a rocket that hasn't flown, the company is quietly selling out the rockets that already do. You could hold this and never think about Neutron at all. The existing launch business funds the weight either way. Neutron is the upside. It's not the foundation. This is the name on the list that asks the most from you. The volatility is real. The headlines are loud. If your conviction is thin, this is the one that shakes you out on a red day. If you understand the business underneath it, it's the one you sit through without flinching. What I watch on Rocket Lab: Neutron's first flight, currently targeted for later this year, and a clean launch re-rates the entire story. But notice how I'm watching it as a bonus, not as the reason I own the stock. The reason I own it already books $200 million a quarter. Now, the part the hold forever crowd loves to skip: the risks. Conviction without the bear case is just hope wearing a suit. There are 3 real risks. The first one is customer concentration. Names like Nebius and Coherent lean on a small handful of giant buyers. Lose one big contract, and the growth story takes a real hit overnight. That's the loud, obvious risk, and it's worth respecting. The second risk is that the AI build-out slows down. Almost every name here is wired into the same wave of spending. The hyperscalers blink and pull back on data center budgets. The orders that looked bulletproof today start getting pushed out. And a backlog is only as good as the buyers standing behind it. And the third risk is the quiet one, the one that actually keeps me honest. These 5 aren't really independent bets. They're 5 different bets on the same trend: cybersecurity for AI, optics for AI, packaging for AI, cloud for AI, and a space company riding the same river of capital. When the sentiment on AI is good, they all rise together. When it turns, there's no safety net and no diversification. They fall together too. Owning all 5 feels diversified. In a real AI unwind, it isn't. That's the risk you only feel slowly, on the way down, when you notice every position is red for the exact same reason. I own them anyway, but I own them with my eyes open and at a cost basis that lets me sit through the drop. Those are not small asterisks. So that's the no safety net 5: CrowdStrike, Coherent, Amcor, Nebius, and Rocket Lab. 5 names with no index money waiting to catch them in a crash, which is exactly why each one forces me to actually understand it, and exactly why I trust myself to hold them when everyone else is hitting sell. But carry the real lesson out of here, because it's bigger than any one ticker. The next red day is coming. When it lands, the market will see 5 falling prices and assume 5 broken companies. You'll see 5 intact theses dropping because other people panic. That gap between the price the market is reacting to and the business you actually understand is where the work optional portfolio gets built. It doesn't get built on green days, when everyone feels like a genius. It gets built on the red ones, when you sit still and everyone else flinches. A falling price was never the sell signal. A broken thesis is: learn the difference, and you stop fearing crashes. You start using them. One more thing before you go. My newsletter isn't a stock breakdown. It's how I use first principles to spot the structural shifts moving markets and the companies positioned to benefit. If that's the lens you want, the link's in the description. And save this video. Watch it again on the next red day, the one where your thumb is hovering over the sell button.